Hello, Dr. Coffee. This is our competitive strategy game presentation. You can see all of our group members under here, and we were Group Denarius. So for our first slide here, we have shown our company operating costs for our group specifically, Denarius. And when you look at our company's operating costs, some things stick out. Our market A capacity cost per unit is 32.2% higher than the mean, taking any entry into market A off of our radar. While markets C and D operating costs, ours are majority below the mean, but their overall costs made them more unappealing options, like the extremely high entry costs for C and especially D. And the last thing you'll notice is our market B marginal cost is 27.9% lower than the mean marginal cost. This combined with market B's 77% scrap value at the end of the fourth period made an ideal first period for market entry. So here, this is our first period move. The first period, obviously, we set the prices, but they didn't make their appearance until after period two's move. But at this point, being the first period of the game, our thought process was to start small. We had no idea as to how much capacity firms would put into certain markets, so we played it safe, and would love to observe. To account for our small capacity, we priced our units slightly higher at $320 per unit in order to earn back one third of the $48,870 on units of capacity in the entry cost itself. In retrospect, we probably played far too safe, leading to a slow start for our group. Our pricing was at a good level, but we bought far too few units of capacity, leading to lots of money being left on the table. Looking at Market B's profile, even if four total firms had entered the market, the highest the profile goes, around 4,000 units would have been sold. Looking at the top image, we and Group John were the only firms to enter Market B, but due to our strategy, we let Group John gain a 99% monopoly on Market B. And that leads us into period two. Now that we have all the prices, as you can see in the top picture on the left, as well as with updated moves, our thought process for period two was to keep our small share in Market B to avoid having to pay the entry cost again. While observing the moves that Group John would make in the future, we assumed that most other firms would not be brave enough to enter Market B after Group John more than doubled their unit capacity to 3,000 units during period two. The only move we made in Market B was hiking our unit prices up to $420 per unit to potentially recoup some of our losses from period one. Instead, we decided to purchase 150 units of capacity in Market C. Market A was extremely oversaturated with firms, and Market D was still out of our budget. Prior to period two, there was only one firm, Group Aria, with only 80 units of capacity. Many firms were still playing safe, only buying 50 to 100 units of capacity, which led us to the decision of buying 150 units of capacity in Market C and pricing it at $400 per unit. Even if a lot of firms bought in, which they did, as long as we held more capacity than any other firm, we could observe how willing they were to run with Market C and plan accordingly.
As we enter into period three, here's the chart for the period results for everyone, and here's our team results. So for period three, we decided to stick with market B and C because we wanted to focus on B and C because market D was too risky and too big to invest in, while the other team has already invested in market D. For market A, we didn't believe that it was worth investing given the benefits weren't like the best or had the best results for our team. So we decided for market B to sell at 420 to undercut one of our competitors, which is Team John, knowing that we did increase our capacity to 1,000, and since we knew that if we did make profit from that, it will help us get more control of market B. We did the same for market C and that we did set the price to 420, thinking our price will sell at a lower price, will make up for the earlier periods. The problem is that we increased our capacity in markets B and C and did not make the sales that we intended. So as a result of that, we lost some cash and our net revenue was at $214,900. We took a risk into expanding to market B and C to solidify our position in those markets, but as period forward, uh, coming to period four, we were losing money and desperately needed to make some moves that will make us some cash. We have lost some money in periods one through four, making some moves that were obviously not the best given the risk. For the markets, we decided to stick with investing in market B and C. At this point, investing in market A and D it's not worth it for us because we do not have leverage in those markets because of other markets were most likely because other teams had most likely had head starts in those markets. We also didn't have much capital for market D because of how risky it could be if we lose some of the money. Also because of the high entry cost for market D and the depreciation rate of 50% after capital is being built. So like even if we did invest in market D, there would after investing in market D, there would be depreciation of assets of 50%, and that is not ideal for us given the losses we had. So we continue to charge lower prices in market B and C, hoping again to undercut other companies to gain some profit. For market B, we lowered it again to 225 per unit, and for market C, $325 per unit. We kept our capacity the same. Team John was our main target and tried to undercut because we knew that they were trying to lower the prices because of the high capacity in market B. And we did our best to have our prices lower than theirs. In the end of the period, our sales pulled through and we gained some revenue as a result of sticking with our capacity prices. I guess our only regret was not increasing our capacity because Team John had a $5,000 capacity and probably lost some money while we could have increased our revenue by increasing our capacity. So pretty much like we did make some money in period four. I wish we would invest in more of our capacity so we would have more to sell than period five.
Yeah, in period five, we really concentrated our efforts on markets B and C as they were still our most reliable sources of income without taking on any new entry costs in any new markets. At this stage, a lot of the other firms were also expanding their capacity in the markets that they'd already occupied rather than entering the new ones. So we followed that same kind of logic. In market B, we held 1,500 units of capacity and we kept our price at $225 as this was still the same as John, our main competitor. The total market demand was over 6,000 units, which meant we were able to generate a steady revenue without needing to engage in any kind of price war. Even though we probably would have won that given our lower marginal costs, we felt if we can both make a profit, we don't need to start engaging. As long as all our units are selling out, then that was still optimal to do. Our costs in this market were obviously still predictable and below that of the average level. So it was a safe and stable way for us to rebuild our cash position. For market C, it required a little bit more of a strategic approach. We maintained our 400 units of capacity and we priced at $325. The market sold just over 1,500 units, which allowed us to capture a healthy share while keeping our cost exposure low. Many competitors were still adjusting their output here. There's a lot of different prices and outputs within this market. So our stable products allowed us to benefit from that without any major price cuts. We continued to avoid markets A and D, A because it was particularly oversaturated and therefore seemingly unprofitable. And market D's high entry costs made it far too risky. We've had to borrow and pay the interest on that. So by staying disciplined, we managed to end period five with $680,000 in cash, which set us up with the liquidity that we needed to make some stronger moves in period six. So moving on to period six, we continue to stay with markets B and C. They remained predictable and limited our downside risk. At this point in the game, a lot of our competitors had defined market decisions defined by their capacity. So maintaining our established presence was really our goal to remain operationally efficient. Market B remained our strongest market. We expanded our capacity in that to 1,950 units and our price to 220 to try and undercut John. The total market this time sold 5,800 units. There was probably some potential for us to increase our capacity in this market even more and really try and take on John, but we felt while we're still making a steady profit, the downside risk, obviously not knowing their marginal cost and not being able to 100% guarantee that it was higher than ours, while we could both make a profit and keep churning out money, we thought that was the best thing to do so to avoid taking on additional risk. In market C, we also performed well during this period. We increased our capacity in market C to 1,500 units and priced at $300. Total market demand was around 1,700 units, of which we captured almost all of it, and that led to a consistent net revenue. Once again, we avoided the markets A and D. Market A lacked demand. Firms weren't selling out in there, and as we mentioned at the very start, our marginal cost in market A was particularly high, and market D remained almost unavoidable with a huge monopoly within that market. So we ended period six with $1.135 million in cash, and that strong liquidity gave us the flexibility to make some larger decisions over the final few periods.
In period seven, we stayed focused on markets B and C since these continued to be our best source of revenue. Competition in these markets are mainly about how the capacity each company had rather than big price changes. By sticking with our core markets, we were able to operate efficiently and generate solid returns without any extra risk. Market B was our main focus. We kept our capacity of 2250 units and lowered the price to 210 in order to undercut Group John's set unit price and ensure we would sell a majority of our capacity stock while also increasing the unit capacity to 2250, which paid off. This gave us a steady flow of cash and confirmed and maintaining our position in this high volume market was the right move. Market C did all right. We decreased our capacity by 200 units down to 1,300 units at a price of 300, and total market sales were about 954 units. We didn't quite do our math right in this move and simply had far too much stock in this market compared to competitors and would have to drop prices dramatically. We still avoided markets A and D where demand was low or competition wasn't really favorable. This helped us keep costs down and maintain liquidity. By the end of the period, we had around 1.3 million cash, which gives us plenty of flexibility to make strategic moves or add capacity in the future when opportunities look right.
Moving on to period eight, we stayed focused on market B and C, which continued to be our most reliable sources of revenue. The competitive landscape shifted a bit, and all our previous capacity had been fully used by concentrating on these markets. We were able to maximize returns while keeping operations efficient and minimizing risk. Market B was still an important market for us, even though our capacity ended the period at zero. We sold 11 units at the price of $1,200. The revenue from these sales was strong compared to the volume, and costs were very low. This shows that our strategy in market B continues to work even with limited capacity. Market C also performed well. We sold 58 units at 720, which generated solid net revenue. This confirms the value of sticking with markets we know well, where we can reliably capture sales without overreaching. We kept markets A and D off our radar since at this stage of the game it was too late for us to generate money for market A and D. For market A, market D had a big entry cost even if we did want to invest in it. This helped us keep costs down and maintain liquidity, which grew to about 2.1 million by the end of the period. Having a strong position gives us flexibility to make strategic moves or invest in capacity when the right opportunities came along.
As you can see, we made a lot of headway in a short couple periods, mainly periods 4 through 6, and that would be because we changed up our strategy to a Bertrand strategy slash in a competition. In a Bertrand competition, firms compete by setting prices rather than over with capacity. With markets like B and C, whose units are almost identical to all firms, meaning prices only deviating by a couple percentage points, the firm with the lowest price tends to capture the market. Profit margins tend to blur when two firms engage in these price wars, which is exactly what led to our success. Our marginal cost for market B is $170, which is 28% less than the average, being $220. This meant that every period we could lower the price slightly to constantly undercut Group Sean, who presumably had a much higher marginal cost than us. It worked perfectly. After our period 4 move, where we decreased our price to $225 per unit from 250, we sold all 1,950 units of capacity and forced Group John to come down to our price as well as scrap 1,200 units of capacity in Market B. Observing the way Group John responded, we decided to continue our strategy. Period 5, we went big and purchased 950 new units of capacity in Market B, while also lowering our price down to $220 to further undercut John. We continued to sell out all of our units of capacity and generated a whopping $450,000 during period 6 alone, officially turning us positive on our $1 million angel investment. This Bertrand strategy enabled us to continue buying capacity to meet the demand generated by our strategic pricing as a response to Group John's major capacity purchase back in period 1.
So Dr. Coffee, this is our trends for our team. So on the top left corner, we have the cash trend, and this is how much money we had. So obviously, every team started with $1 million that you loaned it to us. So for period 1 and 2, we kind of lost some money because we made some some risky investment and it didn't pay off. So at period 3, it was probably our lowest. Then as I talked about in period 4, we started undercutting everyone and started making money in period 4 and 5, 6 and 7 just by using the Bertrand method that Kent was talking about in the last slide. And for capacity, obviously everyone started this with zero capacity because we just for periods 1 and 2 because we know how to like make our strategy work. But period 3 and 4, we decided to increase our capacity or keep it the same, just to play it safe and try to make some money that we lost earlier in periods 2 and 3. And for the rest of the periods, we kind of increase our capacity in some periods, and then for whatever reason, we drop it off at period 8. And our revenue and sales trend, it kind of reflects off of capacity trend because we were making money and selling it off at the same time for 4, 5, and 6, and that's it.
Yeah, so this final slide connects our strategy in the game to a real life example of Patron competition. So Reuters reported that Frontier Airlines aggressively cut their fares to try and undercut their competition as they believed that they had the lowest cost within the market. So they did this in aim to try and capture the price sensitive travelers and build their market out competing on price rather than quantity, as we see in Bertrand. This mirrors exactly what we try to achieve in Market B with our lower average marginal costs compared to the average within the market at $170 rather than the industry cost of 220. And that cost advantage allows us to repeatedly lower our price initially from $250 down to 225 and then down to 220 finally, which on average wouldn't produce a profit, but we were still able to make $50 a unit at that level. This forced the other group, John, to match us with the risk of losing their demand up until their marginal cost. And just like Frontier, our consistent price cutting led us to sell our full capacity while pushing our competitor into scrapping 1,200 units. By maintaining the lowest price, we're able to keep expanding our capacity as we did by 950 units in period 6, generating $450,000 in cash flow, which allowed us to reach above that 1 million mark and recover the initial investment from yourself. The Frontier airline example validates our in-game strategy. When the products are identical, having a cost advantage and pricing aggressively is the fastest path to capturing the market and scaling profitably. This concludes our presentation. I hope you're happy with the steady returns over the periods and what we were able to achieve with your investment. And thank you so much for listening.